Welcome to Yahoo Finance Live. It's Thursday, January 19th. I'm Shauna Smith along with Dave Briggs. Let's get you up to speed on this afternoon's market action because once again, we are looking at losses. The Dow now off 111 points. We're looking at the S&P off nearly 0.3%. The Nasdaq 100 is also in the red this afternoon, off nearly 0.5%. Taking a look at how we have traded over the past 3 trading days in this holiday shortened week, we're looking at losses for the Nasdaq 100 of just over 1.5%. Taking a look at the Dow is also in the red for the week, off over 3%. S&P, same story there, off about 2% since the start of the week. Taking a look at some of the individual movers today, we got the jobless claims number out this morning. Also some hawkish comments from Fed officials. That's prompting the bit of selling that we are seeing today. But in terms of what is bucking that trend and leading today's market action, we're looking at energy up another 1.5% today. Communication services also among the outperformers today. Consumer discretionary and industrials lagging behind. Taking a look at some of the tech names, as there is a bit of a hesitancy out there in the market right now that the Fed is going to remain more hawkish and keep rates higher for longer in the midst of this environment right now. We're seeing a number of the tech names under pressure. Amazon off just over 1% today. And taking a look at some of the bank names, a lot of red on your screen. Once again, JP Morgan, Wells Fargo, Bank of America, Morgan Stanley, the worst performer of the bunch, off just over 2% today. And quickly taking a look at the travel names, we got an update from Norwegian, a disappointing update there from that company, and that really put pressure on Norwegian stock. You look at Norwegian off nearly 4%. That's taking some of its competitors with it. Royal Caribbean off just over 1%. Carnival off over 2% today, Dave.
Always move together, don't they? And the markets just don't seem to generally agree with the Fed.
They don't.
Not quite.
They don't want to.
Yes, earmuffs. All right, Shauna, thank you. Let's get you up to speed now on the Fed. Vice Chair Lael Brainerd spoke today. Yahoo Finance's Jen Schomburger here with what she had to say. Hi there, Jen.
Hi, Dave. Indeed, earmuffs. I just heard your previous comment. Vice Chair of the Federal Reserve, Lael Brainerd, spoke Thursday afternoon and said that while there are encouraging signs inflation is coming down, the central bank should stay the course of restrictive monetary policy. In a speech at the Chicago Booth School of Business this afternoon, Brainerd said, quote, even with the recent moderation, inflation remains high and policy will need to be sufficiently restrictive for some time to make sure inflation returns to 2% on a sustained basis. We are determined to stay the course. Brainerd says she's encouraged by a recent deceleration in wage growth and price trends in core goods and non-housing services, which she says signals we're not experiencing a 1970s-style wage price spiral. When asked what impact unwinding the Fed's balance sheet is having, Brainerd said estimates for the impact are probably about 50 to 75 basis points of tightening. Elsewhere Thursday, we heard from Boston Fed President Susan Collins, who said there are more rate hikes in store, though she anticipates at a slower pace. Pointing to still sticky high services inflation driven by wage growth, Collins said in a speech at the Boston Fed this morning, quote, there is more work to do. I anticipate the need for further rate increases, perhaps at a slower pace, depending on incoming data, before holding rates at a sufficiently restrictive level for some time. Collins says she thinks rates, which stand in a range of 4.25% to 4.5%, should come up to just above 5% before being held for some time at that level. Dave?
And that's where markets just don't seem to quite agree with the Fed, but they're coming around. All right, Jen, thanks so much.
We'll
Good
see.
stuff. Yep, we'll see. Let's get up to speed now on housing. Mortgage rates continue to decline, dropping today for the third straight week. The average 30-year fix now sits at 6.15%. That is down pretty considerably, 6.33 according to Freddie Mac, down dramatically from last year's peak of north of 7%, but still up considerably from the 3.56 we saw 1 year ago. Said Freddie Mac's chief economist, quote, rates are at their lowest level since September of last year, boosting both homebuyer demand and home builder sentiment. And that was some of the big stories coming out this week, Shauna, that we saw a bit of a boost in mortgage demand. We saw a bit of a boost in home builder sentiment, generally speaking, still pretty depressed. But I think it really bolsters the point of view that we're going to be okay here, that the housing market is not going to crash. And it looks like that mortgage rate is going to continue to steadily decline despite a few more Fed hikes ahead.
Yeah, hopefully it does. As we do see improvement in inflation, we're starting to see improvement on the mortgage rate front. It's going to be interesting, though, to see how far of a drop we could see in mortgage rates. I think most of the experts that we're talking to saying that it's likely going to be in that 5 to 6% range. But the question now is whether or not it's low enough to really spark and trigger more activity in the market. My first thought is that still a bit too high. We're going to have to wait for it to fall maybe a couple more weeks, see a little bit more improvement, maybe just below 6%. That will be enough to do the trick. But this is certainly the trend that the housing market wanted to see. We know it has been amongst the hardest hit over the last several months. Certainly I've seen that reflected in the numbers. So now some improvement here. Maybe that will start to help some of the activity out there in the housing market. Let's take a look at the broader market because we are still looking at losses across the board. The Dow off just over 100 points. We want to bring in Brian Jacobson. He's Allspring Global Investments Senior Investment Strategist. Brian, it's great to see you here. So once again, we're looking at losses today. We got the jobless claims number out this morning. We also got some comments from Fed Vice Chair Lael Brainard. What did you make of what we're hearing from Fed officials over the last couple of days and what that signals to you that we should expect in terms of policy?
Yeah, thanks for having me. So I think that when we're listening to the Fed officials, it almost sounds like it's listening to a broken record. And in fact, you can kind of look at previous speeches that they gave, and you can do this track changes thing to say, what did they really change with their statements? Not a lot has really changed. And I think that's just really symptomatic of the environment that we're in terms of they're just waiting for some more encouraging data. I liked Lael Brainard's comments, and I think she's a really important one to be listening to because honestly, I think she's probably one of the smarter ones. I mean, they're all brilliant, but right, she's probably one of the smarter ones on the board, and she's a voting member. Some of the other people who are speaking, like let's say Bullard and even Collins, who spoke today, they're not voting members this year. And so it's always important to not only listen to what they say, but also ask, does their opinion really matter when it comes to setting policy? And I think Brainard is maybe more in the camp of let's hike once more, 25 basis points on February 1st, and then keep the option open to hike more if the data dictates that we should. So I think that it is about that data dependency, and they're just waiting to see, has this short-term trend in the decline in inflation, is that going to continue or not? We believe it will.
Good to see you, Brian. There seems to be a growing consensus that maybe at some point the Fed changes their target subtly to 3%. And you're hearing a lot of comments out of Davos that sound like that. Do you believe that will be the case, say, a year from now?
No, I think that the Fed, so back in 2012, January 2012, they really created this document about a statement of longer run policy objectives. And in there, they kind of codified, hey, 2%. The PCE inflation headline number, that's what we're trying to hit. And they revise that. They sort of reaffirm it, renew their vows to that pledge every January meeting. So that this next one, they'll probably restate that. But they don't really do a policy review to say, should that target change, except for maybe every 5 years or so. And so it's not even really on the calendar. I know a lot of people are saying, you know, maybe they should take this as an opportunity to raise the target to 3%. But I'm not sure what sort of good that would do. In fact, it could actually be more disruptive to financial markets than if they just really affirm that, no, 2%, that's what our goal is, and we're not going to try to move the goalposts quite yet.
And Brian, another worry for investors over the next couple of months is going to be the debt ceiling fight, the looming possible default. How much attention are you paying to that? And I guess how big of a risk do you see that being to the markets going forward?
Yeah, so on our Systematic Edge multi-asset team, we were having a discussion about that. A lot of us have been in the industry for a while. Remember back in, say, August 2011, when it really came to a head. So August 3rd, 2011, it was a great day. My son was born. That was also when they signed the Budget Control Act, raising the debt ceiling. Of course, 2 days later, S&P decided to downgrade the U.S. debt because they didn't like how that standoff went. But we learned a lot from that experience. We learned that the Treasury kind of had a backup plan. The Fed had a backup plan as well. tell as far as what would they do. No, it doesn't seem all that possible to really prioritize payments, all of the payments, but they probably could prioritize payments on the debt. And the Fed, back in the 2013 minutes, if you read through those, it said that they wouldn't want to, but they were willing to step in, maybe buy up the government debt if it did look like they were going to default on it. So to me right now, it looks like it's maybe a game of chicken, but played by turtles that are moving very, very slowly towards each other, one in New York and one in LA. So this will play out over a long period of time.
I can't unsee that. A game of chicken played by turtles, man. Next streaming series coming. Brian, guest after guest here buried the 60-40 last year. You say it could be poised for a comeback this year. Why?
You know, I think one of the reasons is that we've seen rates reset higher. There's actually decent coupon income once again in the fixed income markets. And some of the movements suggest to me that if you have a risk off day and the equity markets, yields now more often than not can actually fall. That was very different than 2012, where any risk off day in the equity markets, so you saw the S&P 500 falling, typically you saw yields rising. Now that's changed. That dynamic has changed a little bit, where people are viewing bonds as being a decent diversifier once again. And so for our portfolios here, we're actually adding some of that duration exposure for those diversification benefits and recognizing that there's actually some decent coupon income if we are indeed correct that growth is moderating and inflation is coming down. Now, if we're wrong with that, of course, we'll be wrong about the comeback tour of the balanced portfolio in 2023. But we have pretty high conviction that that's the trajectory that we're heading.
Sounds good. Brian Jacobson, Allspring, good to see you, my friend.
Thank you.
All right, we're just getting started here on Yahoo Finance Live. Still coming up, our coverage of the World Economic Forum continues. HPE CEO Antonio Neri explains why he's bullish on the cloud industry in 2023. Then U.S. housing starts slump in December, falling for a fourth consecutive month. We'll talk all things housing with the National Association of Home Builders CEO Jerry Howard. And earnings season is starting to heat up. We'll get Netflix's latest results after the bell. Don't go away. U.S. housing starts declined in December for a fourth consecutive month, hitting its lowest level since July. Let's talk about what's ahead for housing with National Association of Home Builders CEO Jerry Howard as part of our real estate report brought to you by Intuit TurboTax. Good to see you, sir. Interesting to see this dynamic, the decline driven by a drop in multifamily while single family projects actually rose. Your reaction to the data and the dynamic that you see on the screen there?
Well, the single family increase is one that we're really looking forward to, and it's reflected in the new home index that we put out every month, going back up for the first time in 12 months. So single family, we think, is going to sort of have a soft landing, solidify, and strengthen, so that by the end of next year, or by the end of this year, the beginning of next year, we think we're going to be in pretty good shape on single family. Multifamily is another question here. Part of it is the amount of building we've had over the past few years. We've done very well in multifamily. And the other part of it is the administration's now talking about putting in rent controls. If there's anything that's going to stop the construction of multifamily housing, it's putting in rent controls. So I think you're going to see multifamily lag behind and stay in a decline a little bit, but single family will strengthen. And we're looking forward to this time next year, a pretty solid single family market with multifamily lagging a little bit behind.
And Jerry, the Homebuilder Confidence Index that you put out earlier this week, rising for the first time in a year. Do you think it's safe to say that the housing market has hit a turning point, or how are you looking at that improvement in the report?
Look, I'd love to say that, but it's only 1 month. 1 month is not a trend make. We're hopeful that we'll continue to see a sort of a stabilization and a soft landing, but I want to wait and see another month. It's a nice solid rise, 4 points, after declining for 12 straight months. But to put it into context, last year at this time we were at 83. This year we're at 35. Big difference. We still got a ways to go, but there's reason for optimism.
And mortgage rates, I think, give people a little more sense of optimism, down to 6.15. Third straight week they have declined. Do you see that continuing? And where do you believe that number flattens out later this year?
I do think we're going to see a continued decline in mortgage rates. We're very, very optimistic that the Fed is going to slow down its tightening. And we think that we're going to end up maybe a little bit below 5 this year. And that's very important. It's also important to remember the cost of capital at the beginning of the pipeline, the cost of capital for builders when they're buying the land, when they're improving the land, is also coming down. And that's crucial as well.
Jerry, you said below 5. That was the lowest that we've heard from anyone over the last couple of months. Given that, the fact that you think it's going to fall so significantly from where it is today, I guess what level do you think it needs to drop to in order to spur some of that activity that we've long been waiting for?
Well, I'm wishing for that. If it gets below 5, I think you're going to see a real jump in housing starts.
Yeah, that would be a real surprise, and certainly unfreeze, thaw things out a little bit. Are there particular regions you are optimistic about in terms of building and that inventory number beginning to come up this year?
Well, you're always optimistic about the regions of the country that are pro-growth, the regions of the country that eliminate or at least reduce the regulatory burdens that builders and business people have to face. So what am I talking about? Talking about Florida, talking about the Carolinas, Texas, places like that.
Jerry, remodeling market sentiment there weakened in the fourth quarter. People aren't moving, and I guess people aren't remodeling their homes, at least at the rate that we had seen. It's still, though, in positive territory. When do you expect that to tick back up?
Well, when interest rates go down, remodeling also ticks back up. So we're looking for a relatively strong remodeling market throughout the entirety of this year.
And overall, just your prediction, your biggest prediction for where real estate is headed in 2023.
Well, as long as we can get the supply chain fixed, and it's been a slow slog getting it back to normal. If we can get the supply chain fixed, I think you're going to see the latter part of this year a real turnaround in new home construction on the single family side. And I think if we can get the supply chain fixed, it'll help cushion the blow on the multifamily side. Right now, cost of capital is coming down. It's about two things: supply chain and regulation.
Jerry, you're not only talking to those within the industry, I know you also have a regular dialogue with policymakers with the Biden administration. What are you hearing from them? And I guess what would you like to see happen in order to better assist the recovery in housing?
Well, I would like to see the Biden administration, if they're not going to be inclined to decrease the federal regulatory burden, I would like to see them put out some sort of incentives for state and local governments to decrease their regulatory burden on builders. That's number one. Number two, I'd like the Biden administration to understand that when you're talking about rent control, there are at least a half of the landlords in this country are small business people who make their living solely by the rental properties they have. Those are the same people that spent their own money to keep their tenants in their buildings during the pandemic, during the Great Recession. There is not as much of a problem as they're making out, and they need to be very careful or they're going to cause a worse problem in multifamily.
All right, Jerry Howard, we always appreciate you coming on Yahoo Finance. We look forward to continuing the conversation in the future. National Association of Home Builders CEO. All right, coming up, the U.S. officially reaching its debt limit. We will tell you how worried you need to be and what comes next. Stick with us.
Treasury Secretary Janet Yellen writing in a letter to Congress that has officially hit our $31 trillion debt limit, and that her department would have to begin employing, quote, extraordinary measures to meet the federal government's financial obligations. Yahoo Finance senior columnist Rick Newman ain't buying it. Rick, you generally speaking are not. It seems like Janet Yellen is taking this very seriously, as is Jamie Dimon. We'll get into that later. You think this is mainly political theater? Now, just given the dynamic, given what we saw in the House GOP leadership fight, how can you confidently say that?
It's always political theater. every single time, and it's always the Republicans who go down this road, and it's always the Democrats who say, we're going to get out of your way, and we're going to let you guys threaten a debt ceiling standoff, threaten a default, because it really doesn't work out politically for Republicans. But here's a simple way to know. Look, both the Democrats have approved too much spending, and the Republicans have approved too many tax cuts for the last, I mean, how far back do you want to go? 20 years, 30 years? Really, let's go back 20. And that's why we have, deficits that are just going to continue to go up as far as the eye can see. And also we can get away with it. So this is a big problem for Janet Yellen because she has to solve the problem. She has to manage the money and move money around, shuffle money around so that the Treasury can pay the bills. And this could get ugly before it gets resolved. But it's going to go on until the very last second, which is probably going to come around early June.
So, Rick, you mentioned it could get pretty ugly. I guess how ugly could that get? What could the next couple of months look like until we hopefully do get it?
2011 is a template for how ugly it could get. And in 2011, it literally went down to hours before the Treasury Department would be unable to pay some of the bills. And what happened in that period of time? The S&P 500 fell by 17% over the course of a month as we were going through that ordeal. The Standard & Poor's downgraded the U.S. credit rating by one notch. It's still at that lower level. And the stock market did not come back for 6 months. So that's a baseline for how bad it could be this year.
Jamie Dimon said we should never question the creditworthiness of U.S. government. That is sacrosanct. This is not something we should be playing games with at all this morning. Would you like him to just say, ignore the noise?
No, you know what I'd like him to do? I'd like him to put his money where his mouth is and say, we're going to look at all the Republicans we spend money on, we give campaign finance contributions to, and tell every single one of them, get this done, get this done, get this over with. And by the way, it's not Jamie Dimon. It's virtually every business leader thinks this is ridiculous. No business gets to say, oh, we're going to threaten not to pay our bills and see what happens. If you do that, your credit rating goes down the tubes. Nobody wants to loan you money and you can't do business. So anybody who runs a business thinks this is completely ridiculous, and it really is. If you want to address the deficit, do it in other ways.
All right, Rick, we want you to stay right here. You are the perfect person then to continue this type of conversation, talking about business leaders, because investors are not only worried about the threat of a default, they're also worried about a recession too, how weak the economy could potentially get over the next couple of quarters. Yahoo Finance asked a number of business executives at the World Economic Forum in Davos about the possibility of a recession and what they're seeing within their business. Let's take a listen.
Everyone's talking about recessions, but of course, when I talk to people and ask them about their business, they seem to think their business is okay. So everyone here seems to think the other person has a problem.
Mild recession, slightly down for a couple of quarters and then back to slightly up and then more normal in 24 and into 25.
I don't think that we are too deep into recession so far.
I think there will be parts of the world that go into recession this year, but we will choose to ignore that in the parts of the world that are enjoying continued growth.
So pretty optimistic was my first takeaway from this. When we talk about the threat of a looming recession, I feel like we've sounded like a broken record over the last couple of months talking about one. When you compare those comments to some of the surveys and the reports, though, that we've gotten out of Davos, they're very optimistic. There was one from the forum, which is of chief economists, saying that 2/3 of chief economists expect a worldwide recession this year. PwC was out with the survey. It was the most pessimistic it has ever been.
Okay, these same people have been saying roughly the same thing for about 9 months. So since we got inflation hitting 9% last June, you have heard economists, multiple economists, many business people saying, we think that this can only lead to a recession within 6 to 9 months, and it keeps not happening. So we are trying to talk ourselves into a recession. It could happen, but I mean, just look at the job market. I mean, something is very different about the economy that's compared with different cycles. We've got a super low unemployment rate, unbelievable job growth, and some other signs that point to a slowdown, but it keeps not happening. I don't know what to say about it. I mean,
again, I think part of it depends upon your definition, because the technical definition of a recession we already hit. So let's erase that then and look at the current circumstances. To your point, 3.5%, historically low unemployment, job creation every month keeps ticking. We're seeing the consumer continue to spend. The only place you could really point to is the earnings beginning to decline. But yeah, to your point, Rick, maybe we're talking ourselves into a recession rather than noticing and observing the resilience of the consumer and the hot employment market. You've heard employers say, we're going to continue to hang on to our employees. We don't want to lose them.
Yeah.
If I could just add one final thought here, we could go through a recession and not really notice at this point. I mean, it's possible that we have a recession that is so mild that it doesn't seem like a recession to most people. We've got people's financial situation is in good shape. People are not taking out horrible loans they can't repay anymore. We're not going to see a bubble in the housing market like we did in 2008, 2009. So it's possible we get this little speed bump in the economy and we just motor right through it. And by the way, that would actually help quite a lot with inflation, bringing inflation down.
Hopefully that is the case.
Yeah, the Wall Street Journal earlier this week,
guys.
61% of 71 economists told the Wall Street Journal recession in the next 12 months.
Them. Just keep
survey
spending.
after survey.
Just keep spending.
Rick Newman, good stuff.
Bye, guys.
Thank you.
Thanks.
All right, coming up, Uber says it's working with automakers to develop lower cost EVs. We'll have more details on the other side of the break.
Time for Triple Play. 3 stocks that we're watching in the final 30 minutes. We have Meta, Tesla, and Uber. Let's kick it off with Meta. Instagram releasing an update giving you more control over your feed. You'll now be able to block posts containing specific words or hashtags of your choice. You're also going to have the option to use quiet mode. Now, that is a new feature that silences notifications, also auto responds to direct messages. The updates from Instagram coming as lawmakers push the company to address harmful effects on younger users. And Josh, we know Meta has been long criticized for the effect that its app, Instagram, has on younger users, as many of its competitors out there in the social media space. I like this. I'm a fan of this, the quiet mode. If you don't want to erase your app, it's a very easy way to keep Instagram, the app on your phone, and kind of put it in the background for a little bit.
The question I have with it, with quiet mode, is the people that need quiet mode, are they going to opt in for quiet mode? I was sort of thinking, Dave, maybe you have this more like the parents, so if you're under 18, the parent has access to turn on quiet mode on their child's app. Something more like that feels like we're getting somewhere.
I'm into this. I'm very into
Because
this.
as it's laid out, serves absolutely no purpose as I see it. We already have what's called the Do Not Disturb feature on every iPhone that silences all those notifications. So as it stands, until they listen to Josh here, completely agree.
Well, maybe that's the next iteration. They should be listening to Josh.
We'll send a memo in. But stock I'm tracking today is Tesla, off a new note from Piper Sandler saying investors should be proactively buying at this point. Analyst Alexander Potter published a note on Wednesday highlighting the recent Tesla vehicle price cuts and the stock's downturn over the last several months as catalysts for the next leg upward for Tesla shares. Piper Sandler points out that including the $7,500 federal tax credit, Tesla's Model Ys are now far more affordable. Now, a graph in the note showed Model Ys had been more expensive than large SUVs like a Chevrolet Suburban or GMC Yukon, and are now back in the price range of mid-size SUVs like a Ford Explorer, and even cheaper than a Jeep Grand Cherokee. Piper argues the price cuts could boost U.S. demand by 300 to 600,000 vehicles. Dave, that graph really did stick out to me, though, when you talk about the fact that a Tesla Model Y was more expensive than those major large vehicles that fit 8 people. But now getting back to earth, I think, a little bit, and maybe being more competitive with some other stocks in the or some other cars in the market.
Yeah, look, you had to be nervous initially about the margins and how much they would shrink with this dramatic $13,000 price cut. But it just, to your point, broadens the customer base so much and almost erases a little bit of that Twitter hangover. If he would just shut up. I mean, that is the one problem. He can't get out of his own way in terms of turning off customers. We talked about how Elon's favorability has been cut in half over the last year since he's been speaking out so politically. But yes, this opens up a whole new customer base. Ross Gerber, albeit a massive Tesla bull, said the bullish case for Tesla is now stronger than ever. And he was very critical of the Twitter situation as well. So yeah, it appears to be paying off. My play also in that space, it's Uber. Shares seeing a very solid start to the year. News today that Uber is working with automakers to design lower cost electric vehicles specifically tailored for its ride-hailing and delivery businesses. CEO Dara Khosrowshahi telling the Wall Street Journal the plan would specifically focus on city use, featuring cars with lower top speeds and with seating areas where passengers actually face each other. The delivery cars, on the other hand, Dara says, could have 2 or even 3 wheels with expanded trunk space, but the CEO declined to specify which automakers he's actually talking with. Uber shares fell 41% last year, but have since bounced back, up 13% this year, with several other big tech names that were hammered last year, pretty much flat today. But this is an interesting evolution they could make. Want to ask you how you'd feel about facing each other, Shauna, in an Uber.
Who, me and you, or a total stranger?
Oh,
if I know the person, it's fine.
Yeah, okay, if it's me, you're out?
No, if it's you, I'm in. If it's a total stranger, you guys are face to face.
Well, that's if it's Uber Pool. You're obviously with people you know and somewhat like in an Uber.
Okay. As long
You
as
want
it's
to
not used
face
for
them.
Uber Pool and just for an Uber, I think it's
Train.
fine. It's kind of like a train, exactly. I don't have an issue with that. I think it's a great idea, especially if these are going to be smaller vehicles. We know Uber and its competitor Lyft have long been criticized for the congestion that they have added to very popular cities like right here in New York. So you think smaller vehicles might be a slight improvement to that. I think the goals of this are very lofty. I love the vision here. I just don't know how realistic it would be in a short time.
Well, one thing that sticks out to me here that I pointed out earlier today when we were talking about this really gets with what Uber is and has wanted to be for over a decade now from its beginning. And I said that this reminded me of Super Pumped. I watched that recently on Showtime. Travis Kalanick. It's about Travis Kalanick, the founder. Great show. Yeah. And that's sort of the character that Kalanick is at that time in Uber, right? He said at the 5-year anniversary, I just looked this up today, just imagine a city where traffic speeds along smoothly and quietly, even at rush hour. This is my dream. That's what one of the co-founders and CEOs of Uber wanted almost a decade ago. That's kind of where they're trying to head with this, I think, in some, like a utopian city almost, which does feel a little big.
I like the facing each other aspect in that I hate sitting in the front of an Uber when my friends are in the back and they're having a drink. But I guess the fact that Uber drivers like to flip on and off the Uber app, sometimes they're driving around doing things and then they decide to work for a few hours. No one wants to drive around in a specific car tailored for delivery or passengers. So That I think
the adoption of it will be might be a little tough. All right, well, coming up next, HPE CEO Antonio Neri joining us from Davos, Switzerland to talk about the state of the cloud industry. Now, HPE is looking to boost its AI offerings. That's next.
Our coverage of the Davos Economic Forum continues with our anchors Julie Hyman and Brian Sozzi speaking with Hewlett-Packard Enterprise CEO Anton Neri about the digital transformation that he says the world is living through right now.
We were here 7 months ago. Obviously, it was a complete different environment. The war in Ukraine was still here. But the microeconomic challenges that we continue to see, they were not as evident at the time. That said, the tone is all about making sure that we focus on that energy transition, climate continue to be at top of mind, and then making sure the private and public sector address some of the biggest challenges we live in today, particularly this transition on the digital transformation that we all live in. So for me, it's always a good time here because I get to learn and listen, and we get to meet our customers and the government officials we work with.
On the latter point, I believe you had a meeting with some U.S. lawmakers. Of course, there are people from all over the globe here, but there's a contingent of U.S. lawmakers. What were some of the priorities, maybe some of the points of agreement between you and the lawmakers?
Well, it's great to see the U.S. delegation here in force, both sides of the aisle. They were very aligned on the top priority, which at the core was really the energy transition and independence. It was a good exchange of ideas and thoughts. Obviously, it's very limited. There's not a lot of time. It was the beginning of the event. But it was to connect with them. And I think, United States has a clear set of priorities, which the energy independence is one of them, but also the transition to renewable, clean energy, and aligned to the climate goals.
So what role does HPE play in that transition?
Well, we as an IT company play a huge role. we think about the digital transformation we are going through. We believe sustainability and that digital transformation are inextricably connected. When we think about the value of data, data can play a big role in accelerating the execution of the plans. Use the technologies that we all now live with, like AI, machine learning, and AI at scale in particular, to do the research we need to do. I think there was a lot of focus around the supply side. I brought the topic about the demand side. When we think about technologies, we have a huge role to continue to drive innovation that reduce that consumption from the demand perspective, while we help the supply side accelerate the innovation to electrification and other means of renewable energy.
Every time we talk to you for earnings, Antonio, we always ask you about your backlog. In the context of all this recession talk that we've heard here at the World Economic Forum, how does your backlog look? And talk to us about your order outlook.
Yeah. Well, we said, obviously 2022 was a fabulous year for us from the demand perspective. We had an incredible order book that gave us a tailwind coming in 2023. We lived, obviously, the supply chain disruption, but I can tell you today that the supply chain disruption is pretty much resolved. There are a couple of things that we're still working through, but the reality is not going to be an impediment to fulfill customer demand. On the demand side, I think the demand is still steady. I think IT continue to be a top priority for investment. That growth that we saw on spend is still up there, but maybe the priorities are shifting. So, for example, when I talk to customers, they tell me resiliency is one top priority. The other one is the use of data to advance business outcomes. The third one, obviously, is cybersecurity continue to be there. But the fact of the matter, cloud as an experience has not been deployed everywhere in the enterprise and not for all the workloads. So we are very enthusiastic about the opportunity going forward. As you know, we have a clear strategy to give customers the ability to consume what they need in a platform-oriented, unified experience, and we believe we are well positioned. Now, we have to navigate through some of the bumpiness, but I think that tailwind will give us a great opportunity to deliver a very strong year in 2023.
Of course, we got the news yesterday that Microsoft was laying off 10,000 people. When you talk about IT spending patterns changing, do you see yourself reallocating resources internally rather than doing layoffs, for example?
Well, we did that. Actually, we started a process right at the beginning of the pandemic. In March 2020, when we announced our, at the time, Q1 results, we shared with the street that we are taking an aggressive stance to reallocate resources in the areas we want to focus going forward, areas of high growth, high margin, and accelerate our transformation to become an edge-to-cloud company. We were heavily criticized at the time. Why you're starting so aggressive so early, And my learning has been throughout my career to basically take opportunities in a crisis to do what you need to do in basically with the leadership that's required. So we believe we have done that. That's the result of what we have done in Q4 as earnings, is the result of many quarters of execution. And we will continue to reallocate resources. In fact, we continue to hire in some areas where we need the talent to continue to accelerate our strategy.
Speaking of talent, Antonio, you also were amongst the first to move your headquarters during the pandemic. It's now well in the ground. Are you a big believer in hybrid work? Are employees back in these offices, not just in the new U.S. headquarters, but also around the world?
Yeah, so the move to Texas has been incredibly successful. But as I said at the time, we got the best of both worlds, right? We built two amazing campuses, one in San Jose and one in Houston now. That gives the opportunity to allocate talent in both locations. Obviously, Texas gives us the opportunity to access talent in a more flexible way, I will say. There is an amazing college system within 100 miles of us. It has been incredible good for us. I believe in hybrid world, but there are certain jobs that requires you to be on site. And we continue to see continued growth to be people back at the office. But it's very location dependent, I will say. For example, in Houston today, I can say more than 70% of the people are back at the office on a consistent basis. The younger generation want to be at the office because they want to interact, they want to learn. And so I think that's a journey we're going through. ultimately we will find the right balance between us and the employees, right, to get the best outcome.
When do we, though, find that equilibrium? Should be interesting. Antonio Neri from Hewlett-Packard there. Getting harder to find a job in tech in 2023. Layoff tracker layoffs.fyi reveals over 120 tech companies have laid off more than 37,000 employees since just the start of this year. Microsoft announcing Wednesday it would lay off 10,000 workers to cut costs. Julian Sazzi spoke to a number of execs at the World Economic Forum in Davos this week about layoffs. Here's what they had to say.
Anything that has people implications are probably the hardest decisions we have to make as executives, but at the same time, they are the right thing to do for the success of the company.
I think it's pretty difficult to say. I think the next couple of quarters are really going to tell us what's really going to happen in the economy.
So while we are not in a position to have to do layoffs, we certainly have, slowed down hiring a bit during the back half of the year.
I think when we see a lot of peer companies laying people off, when we see people in the tech industry really struggling, the idea of throwing in flying in a big performer, spending a ton of money on a lavish party didn't make a bunch of sense.
It did, however, make sense for Microsoft. That was Cloudflare, who really scaled back what they normally do around this time when Davos ends. Microsoft, however, had Sting flown in for a private performance before announcing those aforementioned layoffs the very next day. I don't know if you subscribe to the theory that that is insensitive. I do not. Look, I'm an expert in being laid off and or fired, and you still have to concentrate on building morale within your company, rewarding those employees who are serving you well, building clients and doing business, and that's what they're doing, provided they provided severance to those employees, which Satya Nadella did.
Yeah, exactly. And I also think if you take a step back, one of the big reasons why so many well-known CEOs, why so many policymakers go to Davos is because it is a very efficient way to meet with so many people that make the most important decisions around the world. When you take into account who is there, most of the top CEOs from all the largest companies, a number of policymakers, a number of other leaders from around the world, it makes a heck of a lot of sense why they're spending the money at Davos. I can sympathize with some of the workers that have been laid off. If you see that they're spending so much flying and staying for this performance, I think it would kind of sting you a little bit if you were one of those people
pun very much intended
that were laid off. But I do think the reason for Davos, why that money is spent, makes a heck of a lot of sense because, of course, it is investing for the future and for those future deals. So
I put out some calls. I'm hearing it costs between $500,000 and $1 million to fly in someone internationally of his status and have him perform. So
that's
certainly
actually less than I would have guessed.
Pretty steep though, around $1 million. Now the tech layoffs will certainly continue. I think we'll know we reach that peak if Apple ever decides to join the fray, which quite frankly, it does not appear. But 150,000+ layoffs last year. What happened to the unemployment rate? It went down to a 50-year low, 3.5.
Yeah, we're going to be hearing a lot more about this over the next couple of weeks when we get the earnings reports from all of these larger companies. It's supposed to be one of the toughest earnings quarters that we have had in a long time when it comes to tech. Tech sector earnings expected to decline nearly 10%, 9.5% this earnings season.
Nearly all those companies ramped up hiring in COVID. Coming up, Amazon is discontinuing one of its charity programs. We'll tell you why next.
Amazon ending one of its charity donation programs. Amazon Smile let customers donate a percentage of sales of select items to charity. Amazon now saying that after nearly a decade, the program, quote, has not grown to create the impact that we had originally hoped. It will officially close down on February 20th. Now, this comes amid cost-cutting efforts at Amazon, which includes about 18,000 layoffs. Amazon shares currently lower ahead of the close, off nearly 2%. All right, coming up, we are counting down to the closing bell on Wall Street. All three of the major averages in the red. Then S&P and Dow off just about 0.6%. We'll be right back.
All right, we're just a few minutes away from the closing bell. Let's bring in Yahoo Finance's Jared Billickry to break down the market action. What are we seeing, Jared?
We are seeing some sequential back-to-back days down here for the major indices. The Dow down 0.7%, the Nasdaq down a little bit more, the Russell 2000 off an even 1%. I want to start out with crypto here, and this is interesting. Peter Thiel's venture capital firm, Founders Fund, reportedly closed out nearly all of its 8-year bet on crypto last year, just before the market started crashing. This generated $1.8 billion in returns. Now, that was in March. In April of last year, Thiel fanned the flames against anti-crypto investors at the Bitcoin 2022 conference in Miami. In that conference, he called Warren Buffett a sociopath grandpa and enemy number one. 1 month later, in May of 2022, we know that Terra Luna crashed. Now, the crypto winter deepened at that point, and the rest is history. So timing is everything, as they say. But let me just show you what crypto prices have done this year. Pretty interesting to look at that. Now, we got to shift over to the chip space, and I'm going to get this back on an intraday basis. And we got some news on the export front. The U.S. is cracking down on chips to China, and they may get soon a helping hand from the Netherlands and Japan. Those are two countries that are reportedly close to agreeing to export controls and could be better aligned with the U.S. policy by the end of January. Now, American restrictions already limit exports and also block U.S. citizens from working with these Chinese firms. The Dutch and Japanese measures would simply limit exports. So chip makers like ASML in the Netherlands and Tokyo Electron in Japan, they would join American companies like Applied Materials, KLA, KLA Corp and Lam Research in the crackdown. And you can see here the chip space not necessarily moving on this news today in the afternoon, but let's just take a look at the AMD chart. You can see been down for pretty much the entire day. All right, we also want to talk about the financial sector and Capital One, COF. You can see that dark red spot there. That is one of the most read stocks on the day. And there we are seeing layoffs hitting the financial sector. That's right, the financial sector and also tech all in one. Capital One is eliminating 1,100 tech positions this week, and Bloomberg reporting that employees are invited to apply for other jobs at the bank. Capital One has been heavily invested in technology to improve efficiency, but like many companies recently, is dialing back the headcount. So with a few seconds to the bell, let me just scroll through some of our sector action today. We got energy in the forefront. That's followed by communication services and healthcare. Those are the only three sectors in the green. To the downside, it is industrials, consumer discretionary, financials, and tech that are down.
All right, that closes out today's trading day. The Dow closing off just over 250 points. S&P and Nasdaq also in the red, with the Nasdaq off just about 1% in today's trading day. S&P off just about 0.7%. Let's take a look at some of the top movers of the day. Let's start with Roblox. Shares closing lower this afternoon following a call from Morgan Stanley. They downgraded the stock to underweight, with the firm expecting slower bookings growth in the second half of the year and little upside from advertising in the near term. We're looking at losses of just about 6.5%. So Roblox closing off its lows of the day. But that good news that we have gotten in Roblox recently, the reacceleration that we're expected to see in the first half when it comes to bookings, Morgan Stanley making the case state that has already been priced into the stock. Goldman maintaining Roblox at a sell. They lowered the price target to 19 from 24. So it looks like the second half of the year could be pretty challenging for Roblox.
Yeah, at the open today, the stock was up 28% year to date. So Matthew Koss really looking at it and saying, that's pretty much peak. Not going to get a lot better than that coming off a holiday season, a December that they expected to be successful. Still, though, at this point, when you look at the analysts, 15 buys, 10 holds, 8 sells. So still some bullish thoughts on Roblox. You got to think the gaming sector been pulling back, and as they believe, Activision Blizzard and Take-Two Interactive are the ones that they would bet on. Let's talk Procter & Gamble. Those shares today, if we could put up the stock chart there, closing, down a little over 2% after earnings prior to the bell. The company beat street earnings expectations on the top and bottom line, but reported year-over-year declines in revenue and profit for the second quarter. They raised prices 10% in the quarter, and largely what they're saying is, well, demand dropped off. They raised them 9% the prior quarter. Question, do you think this is a positive Fed story? If you're seeing a company that raised their prices that high and demand dropped off, is that exactly what Jerome Powell wants to see?
I think what needs to happen, right, in order for the Fed to reach some of their goals. So I guess if you want to take an optimistic view, looking at these results, which were disappointing, I guess this is what the Fed needs to see in order for us to continue to get inflation under control. But when it comes to Procter & Gamble, they're in a pretty tough spot. You mentioned that 10% price hike that we've gotten in the latest quarter. They're saying they're going to keep raising prices to help offset those higher costs in the first half of this year. Beauty product prices increased by an average of 9%. Fabric and home care prices up 13%. We know China, a big part of Procter & Gamble's business. They are optimistic about the reopening there. They do expect consumption to rebound, what they're saying, in the mid-single digits. But of course, as you and I have talked about time and time again, the reopening there with the surge in cases, the timing of that reopening is pretty uncertain at this point, and that's something that Procter & Gamble is taking into account. They did, though, raise their sales forecast on those price hikes.
They also improved their market share here in the U.S. by, albeit a slight amount, they improved their market share 0.5% here in the U.S. Echoes what we said yesterday with Staples names just getting hammered across the board yesterday, and basically all those same names, Kraft Heinz, Campbell Soup, Conagra, et cetera, essentially flat today. All right, let's take a look at some of the big EV auto stocks. Rivian and Lucid. You can see Rivian down more than 4% on the day, both trending on the Yahoo Finance website today and taking a hit lower. A note out from Deutsche Bank predicting several companies could miss quarterly consensus estimates and slashing their Rivian price target from 43 down to 28. So it's not just Tesla. Everyone talks about Tesla having lost 65% of their market cap last year. These other names, and what really, when you step back, these names blew first mover advantage. Rivian had it specifically when it comes to pickups and SUVs. And it may not have been their fault. It may have been the timing of COVID. It may have been the supply chains that quite simply broke down. But their chief advantage was first mover. And now you've got GM and Ford and everybody moving into that space, and their advantage squandered.
Yeah, it certainly is going to be a tough road here when you keep into account that the Fed is going to continue to raise rates. We heard from Elon Musk, CEO of Tesla, coming out time and time again saying how higher rates do hurt their company. He came out tweeting that Fed rate increases make cars more expensive for consumers, increasing difficulty level for automotive companies. Rivian today hitting the lowest level that we have ever seen. Deutsche Bank lowering their price target on the stock there, certainly seeing some further losses ahead. When you take a look at how far these stocks have fallen from their peaks, off over 90%, both Rivian and Lucid peaking back in November 2021. They weren't public for that long before we certainly did see that peak in that one-year chart that we have up on the screen right now, off just over 77%. So it's certainly going to be a tough road for this group. And just looking at the losses today with Lucid off another 8.7%.
Rivian at a market cap of $150 billion at their peak. They had no revenue. That, of course, was the problem. And now slide the decimal over, they're worth 14.5. All right, we're awaiting these Netflix earnings. We'll have them for you as soon as they break. But it's already been a busy day in the streaming space. Saudi-backed startup Live Golf announcing a broadcast deal earlier with the CW. 75% of the CW is owned by Nexstar, which bought into the new golf league, while everyone stayed away. And this is essentially a 2-year deal. No money will they get from actually rights fees. This is basically a revenue ad share. So it's not a great deal for Live Golf. It's a great deal for the CW, who doesn't have to buy these rights. But it's been a pretty good start to the year before we get to Netflix for Warner Brothers Discovery, for Paramount, for Disney. There is some optimism in the space.
Yeah, there certainly is a lot of optimism in this space. For Warner Brothers Discovery, Goldman coming out earlier this month, naming it its favorite media stock for 2023. And here's why. They're seeing the catalyst as the recent streaming merger milestones that they have reached. Also, their upcoming streaming relaunch in the spring. We certainly have seen significant gains in Warner Brothers Discovery since the start of the year, and a number of upgrades for Netflix over the last several months. Jeffrey recently upgrading Netflix on its ad tier optimism, and Goldman Sachs boosting its estimates here as we get these earnings results from Netflix amid the weaker dollar. So maybe that could be a positive sign here, a positive move for Netflix ahead of these results.
One last positive thing in the streaming industry. Ted Lasso finally teased.
Your favorite.
Good Lord, Apple.
We're
teasing
down
it.
the time for
Season 3 coming in the spring. We've been desperately waiting for that, as we have been these Netflix earnings. They are out. Ali Canal has them. I know she is anticipating Ted Lasso like me. But first, what do we see from Netflix?
Very excited about Ted Lasso, but guys, look at this stock price after hours. It's up around 7%. Now, they did report really mixed financial results, revenue coming roughly in line with expectations, a miss on the bottom line. However, those subscriber numbers surging 7.66 million versus the estimated 4.5 million. Another strong point here was guidance. That came in very strong for the fourth quarter of 2023. 8.17 billion expected for revenue. That comes as foreign exchange headwinds really begin to ease amid a weakening U.S. dollar. The company also expects earnings per share to come in at $2.82, which is a very, very big number. But guys, another big announcement. Reed Hastings giving up his co-CEO title. He will be stepping in as executive chairman, and COO Greg Peters will be replacing him there to serve alongside with co-CEO Ted Sarandos. So a lot of announcements in this earnings report.
That is a huge
considering
piece of news.
He's led the company for more than 2 decades. I think a lot of
Part of
investors
it from the beginning.
Yeah, exactly. So this is a huge announcement here, and the numbers.
Did not see that coming.
Did not see that coming.
But the subs, I thought was going to be the lead until you mentioned.
I know. I kind of buried the lead there with the Reed Hastings. But yes,
no, because the subs number is massive.
Well, sub numbers are massive. Guidance is massive, and then you have this news of the CEO change. So just a lot to dive into. And I think on the earnings call, there's already so much we had to discuss with ad supported, so many password sharing, and now we have all of this to talk about too.
Yeah, well, good thing that it was a very, very strong report, because I don't know how the stock would be trading on the heels of this Reed Hastings news if we didn't have such a strong beat there. But again, that subscriber number almost double what the street was looking for.
We got a lot to talk about. Allie Canal, thanks so much. Big news there. Coming up, a deeper dive into Netflix earnings. Our next guest tells us why he's been bullish on the streaming giant all along and remains so. That's next. Over 24 states and several high-profile universities have implemented TikTok bans, and a bipartisan coalition in Congress trying to ban the app altogether. Yahoo Finance's Dan Howley joining us now to tell us why an outright ban might be highly unlikely. Hey, Dan.
Yeah, I basically talked to a number of experts, legal scholars, and those who have looked at this before. And essentially the consensus is, look, this is a First Amendment issue for Americans. So the idea here is that the U.S. government officials fear that TikTok is collecting data on Americans, and that the Chinese Communist Party can then pressure TikTok to share that data with them. They're able to do that with any company that operates within China right now. TikTok is an entity that's still related to ByteDance, but has some headquarters in the U.S. So they're desperately trying to distance themselves from this narrative. They also have started moving U.S. consumer data to Oracle's cloud platforms, but that hasn't eased the fears of legislators or regulators in Washington. And so now they're trying to move forward with these bans. We have Senator Marco Rubio had tried to introduce a ban nationwide for TikTok. And as you said, we have a number of states and high-profile universities outright banning the app. There's two things here. Those bans don't really matter. While the government employees can't use TikTok, it only refers to their phones. If it's a government issued phone, you can take your own phone and use TikTok all you want at home if you're a government employee. So it's not actually banning it from all users at all, really. It's just on government devices. That also goes for universities and states. The second issue, though, is would an all-out ban actually work? And from who I've spoken to, it's not going to, because that is a direct First Amendment violation. It would be challenged by the Supreme Court. The Supreme Court has actually held that certain blocking off large portions of certain social media apps is tantamount to blocking free speech. And so it's unlikely that we'll ever see a full ban on TikTok here in the U.S.
Dan, when it comes to what we've heard from the administration, where they stand in all of this, what do you think that we could potentially hear in the coming months as this debate does heat up?
Yeah, I think what we're going to see from the administration is more along the lines of negotiations with TikTok continuing. They're obviously trying to work with them now. They didn't decide to ban it or try to ban it the way the Trump administration had. And the reason being because that kind of effort was shot down by the court. So it's not exactly a way where Biden can just sign a pen or use his pen and sign a paper and say that TikTok is now banned in the U.S. It's just not going to happen that way because of the free speech implications. The other thing that could be pursued is that it's a national security concern. But one of the experts that I had spoken to had said that, look, if Congress does try to play this out as a national security concern, then they're going to have to reveal exactly why it is. And that could reveal the way that the U.S. is able to gather secrets. And yeah, I just want to point out that there was one publication, it slips my mind right now, but the way they said it was, look, if you can read Russian propaganda like RT or watch RT in the U.S., there's no reason why you wouldn't be able to be on TikTok. You can read propaganda newspapers if you want. That doesn't mean you can't be on TikTok. So, it's the same idea. You have access to all this information. Just because it's out there doesn't necessarily, and some folks don't like it, doesn't necessarily mean that you can't have access to it.
All right, Dan Halley, great stuff. Thanks so much. We want to talk about Netflix shares popping after hours. If we can take a look at where it's trading here in extended trading, up just about 4%. The company, the subscriber growth number was a huge story there, added 7.66 million subscribers in the fourth quarter. But another huge headline, co-founder Reed Hastings stepping aside as CEO after leading the company for more than 2 decades. Ted Sarandos, who was already co-CEO, and Greg Peters, who was the chief operating officer, will now be co-CEOs. Hastings writing in a blog post, quote, "Our board has been discussing succession planning for many years. Even founders need to evolve. The board and I believe it's the right time to complete my succession." Let's talk about all this with Santosh Rao, Manhattan Venture Partners Head of Research. Santosh, great to see you here. So starting with Reed Hastings giving up that CEO title, what's your reaction?
I don't think it'll hurt. I think that's okay. It's a natural progression. I think Netflix is moving on to the next phase of its evolution, which is really revenue growth, profitability, and all that. It's really managing the costs, managing the operations, executing well. So I think he was more a visionary, kind of set the stage, grow the company. I think that phase is still going to be there. Subscriber additions are still important, but I think at this point they want to focus on revenue and all the other things. So I think it's good. It's a new change. I think he's been doing it for a long time. And Greg Peters has been around for a long time. He's been a COO and rolled out the advertising platform, advertising tier. So he's well versed in the nitty gritty of the company. So I think it's a great handoff to the next level of management, next stage of manager.
And they will no longer give guidance on subscribers, concentrating on revenue. But the subs here is a massive win here. 7.66 million added on projections of 4.57 million. How significant is that, Santosh?
It's very significant. It's an amazing number. I'm wondering if it's from the ad tier. We don't know that. We need to see the mix. I know they're not going to disclose that, but we'll have to get some numbers out there. Is it the new people coming in? Which it is. I mean, it's a net subscriber ads is 7 million. So it's good. It looks like the ad tier is working, if that's what caused this whole thing. And other than that, I'm telling you, this is the only pure play subscription company out there, subscription service out there They're doing very well, executing very well. They had a nice slate in the third quarter and also in the fourth quarter. So I think they're doing well, and maybe they're attracting new people. It's a fragmented market, the streaming landscape, and they are pulling in subscribers. So as long as they continue to execute, I don't see any problem.
Santosh, when it comes to the clear path to reaccelerate the revenue growth, I think that's been the big question for the street over the last several quarters. The initiatives that they have taken, is that enough?
Well, that's definitely incremental. I mean, password sharing, which is going to come more and more into 2023, and ad tier, which is, of course, like I said, that's their new introduction. That's good. They still need to focus on keeping the base and putting out sticky content. And international growth, that's where the big focus is. That's a long runway ahead. They are in 190 countries. The net revenue from international market is roughly 30 billion. It's a 600 billion market opportunity out there. So I think they have a long runway there. So international is where the growth is going to come from. The developed markets are already saturated, but any incremental at a high cost is going to be net additive to the bottom line. So yes, they will need more and more down the road. But at this point, I think they are in a good position to accelerate their revenues.
How concerned are you about the big miss on EPS?
Well, I am. I was just reading the release. It looks like a hedge. It's more, I think, I don't know the exact word, but I think it looks like a accounting adjustment there. So I don't think it's really an operational issue. It's more something they did with the hedge. So we'll see where that falls when the dust settles. But at this point, it doesn't look like an operational issue. It's more like a hedge that went against them, I guess. So that's what I need to read the release more carefully.
Santosh, what do you want to hear from the earnings call later tonight?
Definitely. How is the ad tier rollout working out? What are their expectations? What do they expect from the password sharing, crackdown on password sharing? Those are the two incremental levers that they are pulling. So I definitely need to know that. And if they can give me a number as to how many of the new ad tier subscribers are original higher level subscribers, or are they new people coming into the ecosystem? So I think I need to see that split. I know they're not going to disclose that, but to the extent they can get more granular in terms of the ad tier, I think that'll be a big plus and very good, very additive to the whole story.
Speaking of additive to the whole story, they were thrown about mentioning potential buyers for the WWE. I was shocked to see them thrown into a handful of names that could potentially look to buy the property. Could you see them making that move? Could they ever make that move into, and I'm going to call this live sports?
Yeah, I think sporting is a very sticky content. Ultimately, they will get in there in one way or the other. But I wouldn't rule that out. I mean, they are optimizing their whole spend. Right now, they're spending $17 billion on the content. I don't know, this is part of that, or will be part of that, or is it something new besides that? So we'll have to wait and see. But I think they will look at everything. I think that's the name of the game. The competitive landscape is very heated at this point. They need to stay ahead of the game, and they are the incumbent leader. So it's their market share to lose. The others are catching up. They need to consolidate. So a lot of that going on. This is the only profitable streaming company out there. So to maintain that and to move ahead, I think they need to look at all the opportunities here and there, gaming and everything else.
The clear market leader, I just want to be clear, you're not ruling out potentially buying WWE.
Hey, if the price is right and things fall into place, I think they will, because they're looking at gaming also, right? As one of their, they already put a foot in that space, but not really totally in terms of live sports and all that. They haven't gone there yet. But this will be something net additive, but we'll see how that plays out. It's very popular. WWE is very popular. So to the extent they can get their content to be more sticky and keep people into their ecosystem, this will be the right move. But let's see. I mean, it's still early. But I won't be surprised. It's not out of the ballpark.
We'll certainly be watching that. Netflix shares up about 4% here after our Santosh Rao. Thanks so much. Well, coming up, chaos in the crypto space continuing. FTX's new CEO saying that the exchange could make a return. We will bring that story to you when we come back.
FTT, the FTX token, popping after the new FTX CEO, John J. Ray III, left open the possibility that the crypto exchange could return. Yes, return. In an interview with the Wall Street Journal, Ray says, quote, everything is on the table, end quote, in regards to the company, including a potential comeback if it provides a pathway to return money to investors and other creditors. He went on to say they are speaking with stakeholders who say they have identified what they see as a viable business. Who'd have thought? Crypto was less a topic of conversation in Davos than it was in years past. It was more of a punching bag in the wake of FTX's collapse. JP Morgan Chase CEO Jamie Dimon doubling down on his pet rock analogy and adding a little flavor and calling it a hyped up fraud this morning. Here's what Brian Sazi and Julie Hyman heard about crypto.
I think Bitcoin prices will come back, but it will come back in a way more organized way than expected. It will follow the interest rate. So when interest rate starts to fall, the Bitcoin price will come up, and everyone will ask, why did the Bitcoin price go up? It's because of falling interest rates.
FTX and SBF are not an exception. They are a rule. Literally 99% of crypto is a scam, criminal activity, total really bubble, Ponzi scheme is going bust.
Lee Drogan is the general partner and chief investment officer of crypto-focused hedge fund Starkiller Capital. Lee, nice to see you. Your reaction to that last comment, a scam, well, 99% of it is a scam. You heard it. What's your reaction?
It's true. I don't know if it's 99%, maybe it's 95%, whatever it is. There's 30,000, legitimate coins out there that trade on exchanges. And yeah, the vast majority of them will never actually be real businesses or attain scale to the point where they provide any real utility. But I think it's important to, at the same time, be able to hold two competing ideas in your mind at once. One, Rubini is correct in what he's saying there. And also, the limited number of these chains and protocols that are very real businesses that will provide very real utility at very large global scale in the future, that's a very, very real and disruptive thing. It's just a matter of time before we see that kind of scale. But yes, a tremendous amount of fraud, tremendous amount of, just ridiculousness.
So Lee, given all that, because at Starkiller Capital, for those who don't know, you're a crypto-focused hedge fund. So you are invested in this business, or you're trading off of this business. You're not waiting for the progress here in terms of what we could see in crypto over the next 5, 10, 15 years. You're out with a new paper, and this is really interesting because it examines the trends of crypto trading. And just to read a few lines from the paper for our viewers here, you liken crypto investing to, quote, a hot ball of money that's constantly rolling in and out of crypto. You also say cryptocurrencies have very little intrinsic value, lacking fundamentals there. So where does that leave us just in terms of why you're trading crypto and that opportunity there?
So if you look at the underlying potential utility for many of these coins and protocols and chains, the way that the market is treating them is basically they're startups, right? They just happen to be liquidly traded. And because of the potential global scale and how fast these things can scale, given that they're permissionless, the market basically tends to massively inflate the value of these things over short periods of time associated with a given narrative. And then, as it takes a lot longer than people think, it eventually, that valuation eventually plummets. When you have these kinds of dynamics associated with early stage businesses, if you want to call them that, they tend to show a lot of what we call a momentum factor. And that momentum factor is arbitrageable in a sense. And so what we do at Starkiller is we take advantage of the specific timeframes on which the history of this asset class shows that you can buy certain assets, hold them for certain periods of time, and then rotate into other assets, and constantly go through that process. And it's been very profitable. And we've shown that, it significantly outperforms Bitcoin, et cetera.
So if someone's sitting at home watching you right now thinking, all right, I've never gotten into the crypto space, are you selling it on a long-term practical usage or merely a short-term opportunity to make some cash?
I think it's both, and you have to really know which one you're in for, right? So in my opinion, there are basically three ways to invest in the crypto market. One is you just buy some Bitcoin and or ETH personally, and this is not a firm opinion. This is my personal opinion. I think Ethereum likely has a larger and more long-lasting utility to this whole thing. And you just have to basically forget about it, because individual investors are really bad at dealing with the kind of volatility that these high growth, high volatility assets have. They tend to puke up their assets at the very wrong time, which would be kind of like right now, instead of, at the top. And so you kind of have to just forget about it for the next 10 years and close your eyes and deal with that. The second way to do it is, kind of like what we do, but that takes, significantly more attention and risk management. But it's not rocket science, frankly. We're not running massive machine learning models. These are, there are many of them, but they're pretty basic statistical models and they work. And then you can day trade, right? And that takes obviously a lot of attention. There's a lot of money to be made there, but you have to be really, really good at it, and you have to have nerves of steel.
Lee, is this any different than what we're seeing in some of the meme stocks? I mean, we try to make sense of all the volatility and all the momentum that we certainly see in that asset class. Does that kind of fall under the same thing?
I think that there are similarities and similar things driving those two variables there. There's not 100% overlap, but certainly concepts like excess liquidity, in the economy, people having time to, in a sense, gamble on things. We like to use the term that the casino of crypto is the boot program for the larger utility of it as we go. You can't have these big crypto networks become liquid and both sides of these marketplaces have enough people on them to have real utility unless you have people who want to be there without a lot of utility existing initially. So the casino of it, the trading of it, the financialization of it is kind of the boot program. When we look at some of these other, meme stocks, it's kind of similar in a sense. They're betting on things that may not have a lot of intrinsic value today. They may not have a lot of intrinsic value tomorrow. And certainly there's interest rates and a lot of the things that drive both of them.
Very interesting conversation. Lee Drogan, Star Killer Capital. Thanks for coming on.
My pleasure.
All right, coming up, Mercedes-Benz saw EV sales surge in 2022 despite a year filled with supply chain constraints and chip shortages. But what lies ahead for the company? We'll speak to Mercedes-Benz USA CEO and President on the other side of the break.
More Americans are buying electric vehicles. Nearly 6% of all vehicles sold in the U.S. in 2022 were EVs. That's according to Motor Intelligence, compared to just about 3% last year in 2021. Now, automaker Mercedes-Benz reporting EV sales were a huge part of its 21% overall growth in Q4. And over the whole year for all vehicles, Mercedes sold 6.5% more cars than they did in 2021. Yahoo Finance's Prosty Ramanian joining us now. We also want to bring in Dimitris Zalakis, President and CEO of Mercedes-Benz USA. Great to see you both. Dimitris, let's talk about the numbers that you put up in 2022, which was a pretty challenging year for the auto industry. Certainly growth and what we saw over 2021. What drove that, and what are you seeing so far in 2023?
I would say, yes, 2022 was a good year for us, and that was based on the product portfolio that we brought up, plus the fact that we had a good support from the supply chain. So all in all, you said it's 6.5% growth compared to 2021. Key success for that was our electric vehicle range. We had 4 models launched in 2022. 2 of them coming very late in the Q4, but they supported in our sales growth.
Hey, Dimitris, Pras here. So you note that the EQ sales doing well in Q4. Also, you said that you guys said that top end, the higher trim level cars really powering sales from Mercedes last year. What is the luxury buyer telling you at this point? Are you still seeing that momentum in 2023?
I think the year started pretty well with high demand on our top-end vehicles, so our AMG products, our S-Class, our SL, which is new in the market, was launched only in summer of 2022, plus our electric vehicles, and we'll talk again about mostly top-end, like the EQS SUV, which was launched in November, the EQS sedan. So these are products which are on high demand. And we see that the start of 2023 was good to have a back order for these products. Of course, it's hard to say how the year will end, but we very strong believe on our total product range. To add to that, there are new products coming also in 2023, which will help keep the demands on a high level.
So Dimitris, what are those new products you're most excited about? Is it the EQE electric SUVs? Is it the EQB, the smaller electric SUV that I actually had a chance to drive recently?
Pras, you got it. I think starting with the EQB, which is our entry model to the electric vehicle range, and the top end on the electric vehicle range is the EQS SUV and sedan. We're launching the EQE SUV in spring this year. And this is the second product that we have in the market, which is produced in the US in our factory in Tuscaloosa. So all in all, as of, let's say, April this year, we'll have 3 SUVs in the market, electric. We'll have 2 sedans. So pretty wide portfolio, I would say, which so far has received very good comments from the media and from our customers.
Dimitris, while we have certainly seen more people, more buyers interested in EVs, I think many remain on the sidelines. From your perspective, what do you think is necessary? What's that catalyst that's needed for more widespread adoption?
I would say there is lots of demand and lots of interest on electric vehicles. What we need to support to get the customers into electric is infrastructure, right? And I think there's investments which are taking place. We also announced a couple of weeks back in CES that we'll develop our branded charging network first in the US. We have announced 2,500 charging stations in the US. So the holistic approach for electric vehicle and giving the customer the convenience of driving a clean car, but at the same time being able to charge his vehicle is what we are opting for.
So Dimitris, I want to follow on that question you mentioned the CES, you guys had announced that charging network. Is that because you guys are seeing customer frustration with how charging stations are operating right now? There's too little chargers, some of them don't work, not enough speed in terms of power. Is that why you're starting your own bespoke network of chargers?
Exactly. It's the customer is looking for convenience, and still there are worries. I buy an electric, and if I need to travel from point A or city A to city B, can I still make it? So have vehicles which have extended range. We talk about our vehicles have 350 miles of range, but by building our own network, we can offer this convenience. The vehicles are connected to these stations. Customers can plan their travels. They can book, they can reserve the space on the charging station. They can plug the car in, and they will offer them also convenience of spending the time they're waiting for the vehicle to charge in a nice, secure place. So it's customer convenience. It's taking away what you said, the frustration, the worry of charging the car.
So Dimitris, I'm actually at the DC Auto Show Public Policy Day here. A lot of government types walking around talking about that IRA and the tax credits and various loopholes like the lease provision, the commercial lease provision that I believe, and correct me if I'm wrong, is Mercedes going to take advantage of that to allow IRA tax credits for cars that are made outside the U.S. and also outside of the bounds of the battery requirements and sourcing?
So at the moment, electric vehicles are eligible to the credits as far as they're electric, and obviously we're taking on using that for vehicles which are commercially leased. But this is not a big volume. This is not the majority of the vehicles. And for the others, for the vehicles which do not fall into leasing, obviously the benefit is not there. We're waiting and looking forward to the clarifications of how IRA will be applied to local manufacturing, to materials and all that stuff to adjust our forward policies.
Dimitris Zalakis, President and CEO, Mercedes-Benz USA. Thanks so much for joining us here at Yahoo Finance.
Thank you.
Well, coming up next, our coverage of the World Economic Forum continues. We are going to speak with EY Global Chairman and CEO on curbing inflation, the recent uptick, and tech layoffs. We'll be right back.
Our coverage of the World Economic Forum in Davos continues. Let's head over to Brian Sazzi and Julie Hyman in Switzerland.
Thanks, Sean and Dave. We caught up with EY Global Chairman and CEO Carmine DeCibio, and of course asked him his top takeaways from the World Economic Forum.
You know, I have to tell you, I came here, I thought there was going to be complete pessimism everywhere. And I'm surprised that's not the case. I'm not saying there's a lot of optimism, but it's much more balanced. I think people are looking at, we will have some kind of downturn in the U.S. and Europe. How long it'll last? Will it be shallow? There's more of a sense that it's going to be short and shallow right now. And I think there's a few factors there. One is all around curbing inflation. And what is that going to take? And are the central banks all going to make the right moves? And my own view is I think they they started too late in terms of increasing rates, but now they're at a point where they can really make a difference here. On that point, though, I do think the labor market's part of the equation here in terms of where inflation really is, and I think there's a lot of headlines around people, being let go and so forth, but you really have to look at how many people are hired by those companies in the last 12, 18 months, and the people that are being let go is a small fraction of that. So the labor market we see is still tight. I think the Fed's going to weigh that in terms of what they do, but I think the timing on that's going to be important. And the other part is geopolitics. And if we can have some kind of resolution to the Russia-Ukraine situation sooner than later, I think that will be a big pop in the market, in Europe in particular, around energy and food, but also just psychologically. So I think those two factors will determine how quickly we kind of come out of any kind of downturn.
It's interesting that you talk about the job market. We were just talking to the CFO of ServiceNow, who was talking about hiring some of the people maybe who are being laid off from elsewhere. And we've also heard the theme that the layoffs are not sort of across the board, right? They're in pockets of areas. What are you seeing on that front? And do you think that we are going to see unemployment climb to as high, perhaps, as the Fed is predicting? Or do you think it's not going to be maybe as bad?
I don't think it's going to be as bad. I do think some of these firings are in pockets. I do think some companies have overhired for sure. And I think most companies are just looking at lower performers and so forth and doing the type of house cleaning that they should be doing anyway. All that being said, I think labor in most of the developed markets in the US and Europe is an issue, and it's a long-term demographical issue. There are just not enough people for the amount of jobs that are needed. And it's ironic because we were here in Davos 4 or 5 years ago saying that technology is going to take away all these jobs and so forth. The reality is technology is creating different jobs, and also it's not coming to fruition fast enough in terms of taking away jobs. And I think demographics are an issue when it comes to labor as we go forward.
We've had a lot of conversations so far at Davos about artificial intelligence, and this seems to be, it feels like this is the first WEF where artificial intelligence, the next generation, is very much out in front. I mean, do you view AI, what this is coming next, as a potential job killer?
Yeah, look, AI will take place, it will replace some jobs, no doubt about it, but it'll also create different types of jobs. And so I do think the next generation of AI will be better and better, but I still think we're not there yet. I still think we're not there yet. And you got to remember, AI, to program anything for any kind of artificial, learning and so forth, it takes time. A machine takes time to learn as well. It's not like on day one it knows everything. It has a lot of factual data, but it's going to have to go through scenarios and so forth to really learn. So that's going to take time, and I think that's the time period we're in right now.
I want to ask about your company specifically, because you guys are undergoing a transformation at the same time that the economy is undergoing a bit of a transformation. Just give us a status report and tell us what's going on.
Yeah, so at EY, we are and have been looking at separating the company, separating into EY into two companies, what we're calling a shortco, which will retain the EY name. That'll be the audit company. That'll be about a $20 billion organization globally in 150 countries in a partnership form the way we are today. And then NewCo will have a separate name, separate brand, new brand. That'll probably be, by the time we do the transaction, probably be close to $30 billion in revenue. That company will be exciting. It'll do everything from strategy consulting to transactions, everything around a transaction, tax. It'll be one of the biggest tax practices in the world, law as well. And then it'll also do business consulting, technology consulting, and outsourcing. So it'll be a platform that it'll enable it to grow in a lot of different directions, and it won't be conflicted. It won't have the conflicts in terms of what's happening today. So that's where we are. It's not only us that are looking at this. Many of our clients are looking at splits and looking at how do they create value today, and we're actually working with many of them.
Can you just quickly tell us what the latest timeline is?
Sure, the timeline, so for us to do this, it requires partner votes from around the world. Those votes will occur in the March-April timeframe. We will then look to operate separately, but still as part of EY, within EY, for a period of time, probably starting in the summer. And then the transaction would probably occur either in the fourth quarter of 23 or the first quarter of 24. So, we're not doing the transaction today, so today's environment doesn't really matter. It's going to depend on where are we basically a year from now. And hopefully we'll be in a different place and out of any kind of downturn.
So, Julie, another CEO that says the world isn't ending, but it necessarily isn't that great in terms of the economic outlook.
Yeah, not a terrible amount of doom and gloom necessarily, but caution. Caution, I think, was the name of the game. Back to you guys.
Terrific work there, Sazi and Julie, and safe travels home. All right, let's get it over to Chana with what's moving after hours.
All right, Dave, we got a couple of movers here for you. We have Netflix, Nordstrom, and Bed Bath. Let's kick it off with Netflix. That stock up over 6%, in extended trading. Earnings were a huge beat, but also another huge headline coming out from this report. Co-founder Reed Hastings is giving up his CEO title. He has been with the company for more than 2 decades, obviously, as the co-founder there. Ted Sarandos and Greg Peters will now be the co-CEOs. Ted Sarandos already the co-CEO. Greg Peters currently the chief operating officer there. Hastings saying that the board has been discussing this succession plan for many years and believes now is the right time to complete the succession. Another huge headline from this report, the subscriber growth numbers. Subscribers added during the quarter, 7.66 million, blowing past the Street's estimate. The Street was looking for 4.5 million. Revenue in line with expectations, 7.85 billion. We're looking at gains of just about 6% here in extended trading over the last 3 months. Netflix certainly has gained some momentum, up just about 15%. Let's take a look at Nordstrom. That stock on the flip side moving lower here in after hours trading, off just about 6.5%. Some disappointing holiday numbers here from the retailer. The holiday sales were off 3.5%. It was a softer than expected period. That's according to what executives were saying. They also lowered their full year guidance as a result, their profit guidance. They now see adjusted EPS of $1.50 to $1.70. That's down from its initial estimate of $2.30 to $2.60. They also see their full year revenue at the low end of their previous range, which was 5 to 7% growth. And again, you're looking at off just about 6% here in extended trading. Taking a look at some of the other retail giants, Macy's off just over 2%, and Kohl's also moving lower, off just over 4% on the heels of that news. So some important retailers to keep in mind for tomorrow's trading day. I also want to take a look at Bed Bath & Beyond. That stock off nearly 2% here in extended trading. Now the retailer receiving a notice from the Nasdaq saying that the company is not in compliance with the requirements for continued listing. This is all because it has not yet filed its quarterly report on Form 10-Q with the SEC. This is for the period that ended November 26. Now, Bed Bath & Beyond has until March 13th. That's 60 days from when it did receive the letter to submit a plan to regain compliance. We're seeing some pressure on Bed Bath & Beyond here after hours, off nearly 2%. All right, coming up next, robotics company Boston Dynamics may have their next viral video hit on their hands. We'll be right back. Judgment Day may not be here just yet, but robotics company Boston Dynamics showing no signs of slowing down. In their latest demo, the company's robot named Atlas, which you can see right here, is showing off some new skills. Now, we've seen robots run, jump, even dance, but Atlas now has hands. Well, grippers is what the company is calling them. And as you can see here, Atlas can pick up some heavy things, place them down precisely, and even throw them pretty far. And then there's, of course, this inverted 540 flip that he does. Dave, this is just incredible. It's
stick
something
with
that makes,
it. He throws the
jumping
tools,
up.
throws that toolbox, which is heavy, up to the construction worker.
Here we go.
Makes his own path down, and here comes the 540 flip. Sticks the landing like Carrie Strug in the Olympics. And that's an incredible performance by a human, let alone a robot, building his own path to the construction worker who says, "You're such a show-off," there at the end. Been viewed 2.5 million times on their YouTube channel. I'm not sure what the practical use is yet, still a private company, but we just heard Carmine DeCibio with Sazi and Julie talk about, are we there where AI is going to replace employees? When you combine AI, what we're seeing with ChatGPT, and now this, you can't help but wonder how many employees are going to be replaceable in the decade ahead.
Yeah, certainly. You would think Atlas is going to be replacing a lot of jobs, at least around that warehouse. It seems like there's nothing he really can't do at this point. All right, well, that'll do it for us today.
Can't do our job.
Finance.
Can't do our job.
Yeah,
All right.
hopefully. All right, we'll see you right back here again tomorrow afternoon. Have a good night.
Yes.